Hello, everyone. Welcome to tonight's webinar. Tonight we're going to be discussing multifamily investing tonight, and some little housekeeping things to go over. So first, if you have any questions throughout the presentation, go ahead and type them in the chat. We're going to go ahead and get to them in the order that they were received. And in addition to Jan, we have another guest speaker. That's going to be Mr. Daniel Woodford. If you have any questions for him in particular, make sure to specify that in the chat as well. So yeah, without further ado, we're gonna go ahead and get started for tonight. Let me go ahead and introduce and please welcome Mr. Nhan Lam. Jan, can you hear me? Hello?
Yes, Nicholas, can you hear me?
Yeah, I hear you now.
I apologize. We had a little hang there for a second there. But thank you very much for the kind introduction and welcome everyone for June the 3rd with tonight's meetup with multifamily investing. This is one of my favorite topics because I tell you guys are into real estate investing, whether you're an amateur or you're experienced, this is the ultimate goal for wealth creation. One of the things we want to do, whether you're flipping homes or you're wholesaling or you're doing single unit rentals or financing, is ultimately own hundreds and hundreds and hundreds of units. So that way you can cash flow for life. And at some point in time, we're going to pass on this earth and we have the ability to leave a legacy behind to our family with this portfolio of real estate that will continue cash flowing whether we're here or not. So with that, guys, let's go ahead and get started with our presentation here and get going there. Okay. So again, for those who don't know me, my name is Jan. I'm the founder of Fortune Homes, and we've been doing these kinds of meetups for the last 5 or 6 years or so. And since the pandemic started, we've been doing this virtually for the safety and security of everyone involved. To not only get the information and content that we're still trying to get out there, but also practice and get safe social distancing and also not gathering more than 10 people in one location. So we'll be doing this month and also next month, and hopefully things will have calmed down to where we can meet again personally, face to face, sometime in August. But we're going to wait and see how the numbers look and how the hotel space looks for to make sure everyone's safe while getting this good content. Okay, I know everyone's misses seeing each other, but we look forward to getting back into the hotel space so we can see each other face to face again. So let's go ahead and get started. Okay. First of all, why do you want to do rentals? All right. So we want to do rentals because this builds your long-term wealth. Whether you're investing in different parts of real estate, rentals and multifamily are the ultimate wealth creation because you can hold them long-term. Now, you're fixing the flip, that's a short-term investment. If you're wholesaling, that's a short-term investment. If you're doing single unit buy and hold, that is long-term wealth, but it's only one unit. Okay. So overall, rentals will allow you to depreciate, you allow you to cash flow, and also be able to earn money whether you're working or not. We mentioned depreciation. One of the biggest things in our tax code is that it allows investors like us to depreciate our real estate, so that way we reduce our liability based on the building assessments of what our building values are. So that way we can segregate the actual value out, and we can offload and decrease our tax liability. Okay, one of the best things you can do to be able to do that. And then, of course, cash flow. Okay, cash flow is the lifeblood of yourself and your family, and having rentals will give you consistent, ongoing cash flow, whether you're there or not. So, one of the reasons why we should invest in multifamily, first of all, it's controlled appreciation through value add strategies. All right, so similar to investing in other types of real estate, we want to find a way to get a good deal through a discount or some kind of motivation from a previous seller or something where you can develop something that someone else cannot see. All right, and that, a lot of times you can buy the multi-unit multifamily buildings that already have occupancy, but the current owner may not see a vision that you see where you can improve the value through various value add strategies. So that way, the value of the property will increase through your effort to increase the cash flow and net operating income. All right, excuse me. The more units there are, the less risk you are, especially if you're in the right marketplace. So if you're currently doing single unit rentals right now, that's a good start. But what happens if that one unit moves out? Now you have 100% vacancy, which is not good for your business. Okay. But overall in multifamily, if one person's leave, you can still have 20, 30, 40, 99 or 100 other units out there still paying rent, whether that one tenant leaves or not. So there's less risk because you have more units, sheer numbers. Also, there's less competition. I mean, a lot of people who watch HGTV or maybe read books and listen to audio, podcasts, and also read different books, they learn a lot about rentals, but not a lot of information related to multifamily. And so they think that the key to wealth is doing, one or two units here and there, which it is a good start. However, everyone starts there. Okay, so if you start big in multifamily, then there's a lot less competition for you to deal with, and it's going to be easier for you to find a deal. All right. Well, first of all, why is there less competition? Okay, that's a big question. Well, people don't try because they think there's a lot of competition. All right. So there isn't a lot of competition. And also, the dollar amount of an actual multifamily unit will actually scare people, because if you're used to doing fix and flip, where you're buying a single family home for $200,000, $300,000, and now you're looking at a multifamily unit where it's on up to $10 to $12 million for 100 units, that scares you, because that's a factor of 10 to 100. All right. So the dollar amounts will actually scare a lot of small investors who are accustomed to smaller amounts. Lack of education. All right. There's not a lot of classes out there that really train successfully in multifamily investing to a proven system, to where a new person can come on and get the A to Z to succeed very, very effectively. Lack of an efficient and proven system. So yes, that is correct. There's not a lot of different ways to skin the cat, but there's a very specific way to do multifamily investing, and not a lot of people know that system. Okay. So, this gentleman, Mr. Daniel Woodford, is a good friend of mine. We've met each other, I say, about 3 or 4 years ago. He came to our meetup, a very humble individual, former veteran within the Air Force, and just very humble. You will never know that he's owned so many units, but right now, to date, he owns roughly almost 200, I think it's like 2,000 units overall throughout the entire country, and brings a wealth of knowledge on what this type of investment is like, and what the rewards are, and what you need to learn to be able to really successful in this type of investment. So, Mr. Daniel Woodford, if you're there, I'll turn it over to you, sir.
Okay, Jan, can you hear me?
Yes, I can, but I can't see you.
Okay, let me see if I can.
Looks like I see the ceiling. Oh, there you are.
Hi.
Wonderful.
All right, thanks, Jan. I appreciate the opportunity to spend time with you today and with the group and talk about multifamily. Certainly hope everyone's doing well in this current environment with COVID out there, both personally and, of course, within your businesses. And what we wanted to do when we presented this presentation today was present it from two aspects, and that is one aspect as a passive investor and how a passive investor gets involved with multifamily investing, and also active investors, because what we found is within these types of groups, there's two types of investors, both a passive and an active. So we kind of tailored this presentation to both types of investors. I'm going to go over basically my story, how I got started basically and got involved, and then transitioned to multifamily shortly after getting started in real estate. Tell you kind of why. We'll talk a little bit about how COVID-19 is impacting multifamily, because that seems to be the hot topic today. How that is impacting, is it significantly impacting, and is it a good time basically to get into multifamily? We'll look at some of the underlying trends that we're looking at as a company to determine the strength of the multifamily market. We'll also talk about how smaller investors like ourselves from a mechanic standpoint, get involved in large multifamily acquisitions like 10, 15, $20 million type acquisitions, even though that many of us may not be in the high net worth category that typically this category really has been reserved for. So there's opportunities now for small investors to get involved. We'll talk a little bit about the webinar series that myself and my partner Christine are putting together, just kind of as an educational basis to kind of help individuals along the way, both active and passive investors. And then we'll look at a case study right after. So this is me about 12 years ago, and maybe 30 pounds ago. This was me when I was in Iraq. I'm a 20-year military veteran, started in 1989, and I got out in 2014. And shortly after, shortly before I retired, I realized I need to really create some passive income. So I started in single families back in 2010 when I got here in the Virginia area. Started investing in areas of Baltimore. For many of you, you probably know these areas also. Probably know Baltimore. Started fix and flips and fix and holds, and built up a portfolio. Then in 2013 or so, we'd made this transition into multifamily to where we are today. And currently, and I appreciate, John, you given us an extra 600 units at this point in time. We did happen to sell a couple, so we're actually right now 1,400 units, a little bit over 1,400 units across the country. So that we're pretty proud of the portfolio. So Mission Bay Capital Partners is a boutique real estate investment firm. And what we really do is we raise capital to place into multifamily properties, both ours as well as a select group of individuals or investors that find deals also that need help in some form or fashion. Maybe it's raising capital, perhaps it's help with securing the financing, or just the experience to ensure that they have a successful investment for themselves and their investors. Again, we focus on multifamily properties, and really our markets are Mid-Atlantic, the Southeast, Texas, but we own properties also in Phoenix area because that's also a growing market, actually a very strong market. Right now we're at 1,405 units, and our portfolio is valued at about $135 million. So what's going on with COVID right now? Many have asked us this, and Christine and I get this question all the time, particularly from our investors. And one of the things that we found is that, particularly across the nation, but also we'll speak specifically for our portfolio, and that is COVID-19 has not had a significant impact yet, and I stress yet, on our portfolio. And we hope that it doesn't, but we'll talk about some of the things that potentially could impact that. From a collection standpoint, we're collecting very well on all of our properties across the portfolio. We're well into the 90%. And then we've had some properties that haven't had any impact at all. So collections right now are good. We are, but still cautiously looking at the scenario because we don't know how much of an impact government assistance is having on that. You know, with the checks that went out recently, and also with the unemployment benefits that are out there, we don't have a great handle, and I don't think anyone really has a great handle on how much of an impact that is having on people's ability to pay rents, and will they continue to be able to pay rents once these subsidies end? From an operation standpoint, we've really looked at our processes and kind of curtailed a lot of activities that we used to do. We've got our leasing office is currently closed on all of our properties, so the door remains locked. However, our leasing staff still is at the property. The door's locked. They don't come into contact with the tenants, and the tenants don't come into contact with the staff. So we want to protect both the tenants and our staff, and so we do that. With regards to maintenance, we're only doing emergency maintenance at this time. So tenants can call our offices, or they can go online and schedule an emergency repair. But at this point in time, to fix something that's a non-emergency, we're just not doing it. We're just keeping our maintenance staff safe. And whenever they do go into a unit, they're completely protected. I don't say completely, but they're protected with masks and gloves and that type of thing. So we ensure that they're making sure they're taking all the precautions necessary. And the bottom line is we're in capital preservation mode, right? We want to make sure that there's not going to be any impact to our properties. And thank goodness there hasn't been a significant impact to our properties yet. But we are currently in the process of ensuring that we're not doing any major type of expenditures right now, or unnecessary expenditures right now. Only emergency type expenditures at this point in time, because we want to retain our capital and ensure that we are well capitalized when we get through this environment here. And lending was really one of the keys to this whole scenario. Right around the mid-March timeframe, when really this started to really significantly hit the economy, and things started to shut down. We actually had a deal that was in the pipeline, ready to close within a week or two, and our lender came back in the first week, and that day, I think it was on a Monday. Yeah, it definitely was on a Monday. They called and said, "Hey, the deal is still good, even though the capital markets are really going crazy right now." And currently, they actually are shut. Basically shut down. They're currently still at some level of shutdown. And they said, well, your deal is still good. That's on a Monday. On a Wednesday, they came back and said, "Hey, the deal is going through review. It probably is still good. And oh, by the way, you're going to probably have to bring, 2 or 3 months worth of interest reserve in to be able to close this deal, because we don't know what's going to happen with the economy at this point in time, and we may need you to have some reserves in escrow, so that if something happens, we can meet those needs. And then by Friday, and by that time, it seemed like an eternity, that the exact same week, lender comes back and says, "Hey, listen, the deal is still on, but you've got to bring a year's worth of interest reserve to the table." And that's enough to kill almost any deal, to be quite honest. Luckily, we had a significant number of reserves already programmed into this deal that we closed in South Carolina, that we were able to take reserves from there and put it into escrow and bring that to the table so that we could get this deal closed. That ended up being about $500,000 that we needed to bring to the table. So basically, we're proactively managing through this pandemic, and we're just kind of wait and see, just like many operators, to see what's going to happen here in the next couple of months. But we're taking actions to ensure that we come out stronger on the other end. But one of the things that some of the underlying factors that we think is going to cause multifamily to be strong well into the future is the housing supply in this nation. And many of you have probably heard it. Housing supply in this nation is very short right now. There's a lower level of affordable housing here in the country, and so as you can see in 2014 and beyond, it's significantly gone into the red, where we're over 1 million units short in this country. So that bodes well for multifamily. When you add on top of that, renters, the core renter group right now in the United States, 20 to 34, which, millennials basically, you can see over time, on the left side of the chart in 2020, that we're sitting, just under 69,000 units, 69 million units that are needed. And you can see over time how it's just gradually going to go up and up and up. So renters, the renter population is just projected to go up. There's a lack of supply in the market. So that just bodes well, again, for multifamily and rentals in general. So again, like what I wanted to say is, I want to look at this from a general partnership as well as a limited partnership perspective, and in passive investor as well as an active investor like myself. And how does a small investor get involved in something like this, where you're actually able to buy a $10 million building or a $20 million building? And that is done through what's called a syndication. Now, many on this call have already probably heard of a syndication, and maybe already involved in a syndication. But essentially what a syndication does is it allows smaller investors like ourselves to compete with larger high net worth individuals or institutional investors like hedge funds or family offices. It allows us to compete side by side by pooling individual investors' money together to put together a large pool of capital to go out to buy these assets. You've got your limited partner, obviously the top three on the top, that bring all the capital together. They buy shares or purchase shares of that LLC right there in the middle that owns the entity. And then there's a general partner off to the side that's running the day-to-day operations and essentially paying that limited partner a dividend or a preferred return each month or each quarter. When we do this from an active investor side, and we'll show you the passive investor side here right after this slide. But from an active investor side, we use technology in our online portal. Our online portal helps us manage all of our investors. It helps us to help our investors get their documents, see opportunities, get them all of the communication that they need with regards to reporting, their K-1s every year for tax season and that type of thing. And it helps us to manage the entire project and basically, ensure that we're taking care of our limited partners as well as we can with regards to getting their documents and helping them to helping them with the transparency of the entire operation. From a limited partner side, as you can see, this is a typical syndication. I blocked out confidentially all the names of our investors, but this is an actual screenshot from our portal where we're seeing various different investors come into into an investment. As you can see, the investments range from $100,000 to 50 to 25, and then there's somebody down at the bottom that invested $200,000 into this specific project. And so you can see also across up there in the top right hand corner that you can see the number of pages of these investors that we have in this project. There's 10 investors here, and there's 8 pages of investors. So in this project, we have actually over 80 investors in this deal. We actually raised right around $9 million for a project just recently. Well, actually, it was like a year ago. So that's what it looks like. If passive investors are coming in, they read their documents, they sign electronically online, they monitor the progress of their investment, they get the communications, they get the K1s. So right there on one spot from a online portal's perspective. This is what kind of a hypothetical return looks like. So when you're presenting this to your limited partners and you're presenting an opportunity from an active side, you can see that on the top yellow line there. So you can see the annual cash distributions to members. They're getting a cash flow every year, essentially, based on projections. So 7,000 in the year 1, 7,000 year 2, and then it jumps up to year 3 and 4, and it starts really ramping up. And typically in year 1 and 2, you're in the middle of the value add, like Nhan talked about, right? You're doing your value add play. You're either renovating units or you're transitioning the tenant base from one tenant base up to a higher tenant base. And a lot of this, believe it or not, takes a significant amount of time. And a lot of new active investors might miss that. To do a renovation on a 200-unit building can take as much as 3 to 4 years. So you need to project that into your projections and account for that. And then at the end, in year 7, as you can see, there's a large capital influx there from the sale of property. And so the investors will get cash flow all the way through. And then in year 7, get a large influx of capital from the sale when we sell the property. One of the things from again, a general partnership and a limited partnership perspective is that you've really got to understand who the sponsor is of the deal. Who is the general partner? Who's the one that's putting it together? You got to understand their track record, their team, what types of technology they're using. And we call it the 4 T's: the track record, team, the technology, and then trust. And I would say the track record, all of these are critical, but the trust is probably the most important because you just got to, you're entrusting your capital as a limited partner to an operator, and you're hoping that operator will invest it wisely, manage it wisely, have the experience to do that, and then produce the returns that you're looking for. As an active investor like ourselves, like Mission Bay Capital Partners, we take it very seriously, and many operators across the nation, there's very good operators out there, take it very seriously that we've been entrusted with capital from our investors. A lot of them are young families or retirees or those types of individuals who they just can't afford to lose capital. And so we really take it seriously. But when you're looking at this so that's what you're looking for from a limited partner side. You're looking for the track record, making sure that the individuals have a good track record. They've accomplished this before. This is not their first rodeo. You're looking at the team that they bring in. Who is the property management team that's going to be on the site day to day? Do they have their own property management team, or do they hire it out third party? Either way is fine, but you just got to understand the track record also of that team. So are they bringing a solid team with them, from inspectors to contractors to property management folks to their CPA that handles their tax returns? All of this is critical when you're looking at an opportunity. The technology piece, we talked about our online portal. We talked about online portals. A lot of active investors are implementing those. And then the trust factor is just a kind of it's really a feel. You're looking at the reputation. You're looking at the history of transparency. You're looking at communications that's provided. Do they communicate with investors monthly, quarterly? How do they do that? And so you're kind of looking at that. So from a general partnership side, if you're looking for a sponsor, a general partner also would look for a sponsor. A general partner who goes out and, let's say, finds a deal on their own. A 200-unit deal for a new person is not advisable. First off, to do it on your own, and then from the second aspect, banks and lenders and investors are not going to invest money or lend money to a new sponsor. So from an individual who's looking to do what Mission Bay Capital Partners does with Nhan, we would we could provide that role, and you'll have that opportunity for an active investor to also get involved and have a sense of safety, kind of a safety net or mentorship along the way. It's kind of how we did it when we started. We got involved with a seasoned real estate investor and developer, and now we're kind of where we are today. So when we talk about, Nhan kind of hit on it earlier, and we talk about tax benefits. Wanted to kind of really hone in on what has happened on recently in the tax code with regards to depreciation. On the left-hand side, as you can see, many of us are familiar with the straight line depreciation, where you take 100% of the building and land over 27 and a half years for residential. For multifamily, that is the case. And you divide that up evenly, and that's your depreciation essentially over the course of the whole period. But accelerated depreciation allows you to kind of compartmentalize a lot of the building. So your HVACs have a certain year aspect to it. You're able to depreciate it on a 5 or 7 year schedule. You can depreciate your plumbing separately, your light fixtures, and what happens is you're able to bring a lot of that depreciation. Let's say it's a 5-year depreciation schedule. You're able to bring a lot of that 5-year depreciation up to the front. And so you get a lot more depreciation over the first years of ownership, which is really beneficial to many of the investors. From an active standpoint, you're providing that to your investors. From a passive standpoint, you're getting much more passive losses that you can apply to not just this property, but also to other passive income that you have in your portfolio. So it's a significant loss that you see here on paper, that is. The other thing that many of us may not be aware of is that we can use self-directed IRAs in investing in a syndication, right? We have a significant number of self-directed IRAs, or individuals with self-directed IRAs that have invested in many of our projects. From a general partner standpoint, we can't typically use a self-directed IRA in our own projects because, again, we can't manage a project that we actually are investing in, right? So it's kind of a prohibited transaction. But from a limited partner standpoint, individuals can use their retirement funds to invest in these types of syndications. So that's a large chunk of the capital that we were able to raise. In evaluating a multifamily deal, we just kind of wanted to get across from both sides. It's critical to be able to evaluate a multifamily opportunity. We already talked about the sponsorship standpoint, the experience and the team and that type of thing. So I won't belabor that. But from both standpoints, you really got to know the market. You've got to know the trends, the occupancy rates. What's the crime look like? What's the job growth? What is the population growth? All of these aspects are key indicators when looking for markets to invest in and properties to invest in. Again, you notice that I have the sponsor though at the top, again, because most of these deals you're really investing in the sponsor. Once you get to know that sponsor, you're really investing in the sponsor from a level of trust, but you still got to understand these types of things in the market. You want to make sure that there's conservative underwriting that's being done in these types of deals. So in our case, we like to be very conservative with our income and expense growth. So when we calculate that across a 5-year hold period and we're calculating the growth of rents that are coming in, do you see somebody that's putting in a 6% rent growth somewhere in there without kind of any type of rationale? Because typically you don't see that type of rent growth. Typically it's 1.5%, 2.5%, 3%. Well, let's call it 1.5% to 3%, depending on the market. You really got to know that, because if the underwriting uses higher income growth, that can significantly inflate the returns. So you've got to completely understand that. What is the exit cap rate that the person is using to calculate the returns or the exit when they exit the property? Is it lower than when it was purchased? Because going trends right now is that everyone is expecting cap rates to just increase over time at this point in time. So what we like to do is we project a higher cap rate at the sale, and of course, higher the cap rate, the lower the value that you will get out of the building. We project that so that we can be conservative in our returns. One of the other biggest pieces is plenty of reserves. One of the biggest things that kills a multifamily deal is not having enough reserves set aside or underwritten into the project to ensure that if something happens, particularly like a COVID-19, now you can't project that. You can't project anything like that happening. But if something happens with plumbing or something happens that's significant, maybe there's an issue with the roofs that you find later down the road, you have the reserves in place. You have the reserves in place to be able to take care of that. And then the final piece is an executable business plan. Remember, I talked about the rent, increasing rents or changing over the tenant base, how that takes 2 to 3 years. If you see a project that shows we're going to change over the tenant base in 1 year in a multifamily, that's not typically realistic. Or we're going to raise the rents on everybody up to market rates. Well, in many of these projects, just kind of a real world scenario. Some of these projects, you've had people that have been living in that property for over 10 years, and maybe the previous seller has given them a good deal on their rent because they've been such a great tenant over the years. Or maybe it's an older person who they gave them a good deal on the rent because they've been there for a couple of years. Are you going to go in and automatically raise that rent $200 right off the bat? That's just too big of a jump for anybody to try to take on. And so, is their business plan executable? To raise rents to market, it takes a year. It takes 2 years really to get that done. To renovate units on a large building, it takes 3 years, maybe 3 to 4 years. And so you got to make sure that the business plan is executable, and then you're buying right. Market cap rate is correct. You're paying the right price per door, so you're buying it right. You're kind of doing your research, and that's kind of the going trend when you're looking at and evaluating a multifamily deal. So because we kind of understood that there's some pieces lacking with regards to individuals looking to invest, whether from an active side or a passive side, there are really 4 basic things that we found that many people want to have more information on. So from evaluating a sponsor, some of the tax benefits that are available, using retirement funds, and then how do I evaluate a multifamily deal to see if it's actually a good deal. So we're putting together, Mission Bay Capital Partners is putting together a webinar series. It's called Did You Know? And we're going to talk about in depth all of these aspects, all 4 of these aspects. And we're going to start that in June, but we'll have more information. And if you email me or email Jan, we'll get you the information. We haven't finalized it yet, but it's going to be end of June, towards the end of June timeframe when we start the first one. We'll probably do it every one of these series every week or maybe every month. We haven't figured out the timeline yet, but that's something that's coming down the pipe. So if anybody's interested, certainly give myself or Jan an email. I wanted to do, to kind of close this out, do a case study for individuals, for everybody on the line to see an actual multifamily in progress. Now, Jan was gracious enough to allow me to come in and present a couple years ago, and we had just acquired this property. And for many of you, maybe it looks familiar, but for many of you, it's probably the first time seeing it. This is a project in Georgia, and one of the things that we saw when we came into this project is there was too much payroll here, right? They had 7 or 8 people in the as part of the payroll, and for a 200 unit building, it takes 4 to 5 individuals. 5 pretty much is probably at the most, and maybe it's 4.5, but it's probably right around 5. They had 7 people. They had 3 units that were down. In fact, they had 2 units that were being used for storage. I don't understand that aspect, but they were using them for storage and they weren't even generating any income. And so we immediately saw an opportunity there that if we brought those units up, we could bring the value of this building up. Had an outdated curb appeal. When you get to the next pictures, you'll see that the color scheme was completely 1970s. The windows were original, just in bad condition. The signage was even even worse. It was 1970 signage. And then there was like this institutional looking chain link fence that was around the property. It just made the property look institutional and just not appealing at all. And one of the things that we liked about it, again, was that 60% of the units were already renovated. And so we were able to go in there and actually see what the potential increases were without even having to take the significant risk of starting fresh with the first unit renovation to see what the rents would come in at. As you can see, the color scheme, like I talked about, kind of this dark brown with a yellow on the buildings. Look at the signage over here to the left. It just looks hideous. I mean, that sign is, clearly from the late 60s. And then the pool was kind of tired. As you can see, the furniture was run down. The pool deck, had some cracking to it. And you can see the chain link fence behind the pool back there that you can kind of see. That really, really made the property look, look drab. This is what it looks like today when we went through there to renovate the property. It probably looks like a lot of the things that we do from a single family standpoint. We go in and we potentially add siding to the property, maybe paint it so that it is a nice modern color, like a cool gray like we have here. We painted the trim white. We brought in a more modern sign, as you can see on the left-hand side. And then the pool, again, we added new furniture and we added a pool deck. I don't know if you can see it back there, but there's a pool deck behind there. And then if you see the fencing, it's that powder coated black fencing. It's as opposed to that chain link fencing that was there. And so we've changed that out. Here's some more pictures of the pool. We added some decking around the lake. This is a property that was fully on a lake. You can see in the bottom left-hand corner, again, this is essentially 200 small renovations, maybe two-bedroom home renovation, a two-bedroom home renovation. You put, new cabinet fronts or potentially even new cabinets if we need them, countertops, flooring, paint, and then all of a sudden you raise the rents by $100 or $75 or sometimes even more than that. And so that's what we did here at this property. As you can see that. And here's what the numbers look like. It's a 211 unit property, $10.5 million purchase. The net operating income was $726,000 when we purchased this, and that came out to us, basically a right around 6.8, I think, cap or somewhere in that area, maybe close to 7. The value add budget that we had was $1 million, and we're pretty much completely, we're probably 85 to 90% done with the value add. Again, we've owned it. Recall that I said it takes several years to get this done. This is our third year of ownership, and we still are finishing up the units. So that kind of gives you a real world scenario of how this works. When we presented this a couple of years ago, the value was at $13 million. We just recently got an offer. In fact, it was this week from a gentleman that said that they would do an $18 million purchase price on this deal. And so we're pretty excited about the project and really how multifamily can really, you can grow the value of the building, and it's not dependent on comparables next door, kind of like a single family. You can grow the value of this building significantly just by running it properly. This is our executive team. Myself, Daniel Woodford. Been around multifamily since right around late 2013, early 2014. So I've been doing this for a while. We've done well over 10 projects, 10 syndications. Of course, my partner, Christine Jefferson, just invaluable in capital raising. She's just phenomenal in the way that she's able to raise capital for this company. And within the last year and a half, I think we've raised somewhere close to $18 to $20 million just from doing these multifamily syndications. So at this point, I'd just like to turn it back over to Nhan for any questions or discussions. But again, appreciate the opportunity to get in front of you and talk about the multifamily and some projects that we have going on. And again, wish everybody the best in their investing.
Awesome. Well, Daniel, can you hear me?
Yes.
Okay, fantastic. Well, congratulations on that offer. That's pretty exciting. $18 million from a start of $10.5 million. And I remember that same exact property 2 years ago. So
Mhm.
a lot of work's been done for that. So congratulations there. So now what we're going to do now, guys, is really take questions. And I'm actually going to turn it over to Nicholas, and he's going to be reading the questions in the chat tool and then asking Daniel them so he can get those addressed. So Nicholas, I'll turn it over to you. All right, Nicholas, can you hear me? I think you're muted out there. There you are.
Oh no, I hear you. Okay. Yeah. Okay. So the first question that we have is for Daniel. It's from Mr. Tom Reed. He asks, do you buy used or build new? Or buy new? I'm assuming that says buy new, but he put build instead.
No, we don't do any ground up construction currently. Full up ground up construction. So we buy them already built, structures that are already built. Typically, it's a Class B, Class C property. They're usually anywhere between 10 to 20 to 30 years old.
Okay. And Thomas asks, when you mention the 1,400 units, is that 14 separate buildings or 14 individual units spread out through various properties?
So that's just adding up the number of units within an apartment complex like that. That one that we showed was 211 units. So so basically we add up the number of units within the complex to get to a number of doors, a number of units.
Okay. Someone is currently typing, so give it a moment.
So while we're waiting for a question, Daniel, are you going to accept that $18 million offer? Or are you going to counter that?
Actually, we're going to counter, to be quite honest, because our broker says that he believes that he can get a lot more for it. He thinks he might be able to get close to 19. So we're going to counter.
Okay. Great. Yeah, it's great that they be willing to buy it now in the current marketplace. I mean, they may see something that we don't. I don't know.
Mm-hmm. Yeah.
Okay, great.
Okay. Jacket asks for Daniel, is multifamily investing mainly for people who already have a good amount of capital?
So yeah, I think the answer to that is it depends, right? So when I started this building, this business, I didn't have a significant amount of capital. So the answer to that is it depends. Now, for an individual that is a limited partner, when we look at limited partners, on the other hand, we look also, we kind of evaluate all of our limited partners based on their financial strength and their knowledge of the risk of investing. And we would never take an investment from someone like an elderly person who perhaps this is their last $50,000 and they just want to put it somewhere. We wouldn't take that type of investment. We would want to make sure that because obviously we know that there's risk involved. We want to make sure that it's that something happens that's not that person's last amount of capital. And so it just depends, to be quite honest, depending on what side of the coin that you're on.
Okay. And Lisa asks, how difficult is it to get started in multifamily investing?
Well, like anything, it's there's challenges, and then there's things that aren't quite as challenging. And for us, we started in it must have been July or late summer of 2013, getting educated. That's kind of what we started with. We started to get educated. We got a mentor. And then by the end of the year, we had already bought our first 40 units. So that's maybe faster than typical. You might expect a year to go by before you can find your first one, because again, you're breaking into the new business. And then it also depends on how you approach the aspect too of starting this out. If you go out and find an experienced person that you can leverage their resume, because again, banks and investors like resume. If you go out and leverage someone's resume, then they can happen faster rather than slower. If you go out and maybe say, well, you know what, I want to just start slow, do this on my own. I'll start small, then go up and get my own experience. That's going to take a little bit longer. It might be a little bit more difficult. So if I could give anybody any tidbit of information to when they're getting into this business, is really look to bolster your resume when you go into these deals.
All right. And James asks, This is for you, Daniel, as well. What kind of reserves do you like? Debt coverage ratio?
Yeah. So the reserves that we like to have, I mean, we don't have a solid like formula, but in general, we like to have about a year's worth of debt service. So on this most recent project that we closed on, 1 year's worth of debt service was 500,000. Our reserves were at 600,000. So we like to have a significant reserve lined up. And again, remember, even to break into your debt service reserve like that, you a building would probably have to be at 70% occupancy, and that just doesn't happen that often unless something happens. And as you can see, in the middle of COVID, it hasn't even happened. And so, there has to be something, there has to be, so 600,000 is a good solid number for that project that we talked about. Debt coverage ratio, from a debt coverage ratio, that one is another, it depends on what type of loan you're getting. So currently, what we like to see is higher than 1.25, which is what the banks typically require. And it could be a little bit higher in this market. And so we'd like to see somewhere, maybe right 1.4, 1.5, but it just depends on what type of loan and what kind of debt you get.
Okay. And Joey asks, how do you find your properties? Are they referred to you or do you actively look yourself? And also, are there any online resources you can use to seek out opportunities?
Yeah, so we get our opportunities from broker relationships. We've built broker relationships over the years, and that's where we get a bulk of our opportunities. Well, let me step back. We get probably 30 or 40% of our deals through broker relationships. The other percent actually come from other investors who are looking for assistance with, qualifying for a loan or help with a raise or the experience, like I talked about. So we get, that's the two main ways that we get our deals. Are there online resources you can use to seek out opportunities? I mean, there's opportunities on, each brokerage house has potentially online kind of platform where you can see opportunities. I can think about LoopNet as another one, but that typically by the time that a deal gets posted online, it's not really a good deal. Because in this business, it's all relationships. And typically, if it's a good deal, brokers are taking it to their top buyers first. They're going out to their top 2 or 3 buyers and saying, hey, here's a great deal. And if it isn't bought by those top buyers, then it probably is not a deal. And that's when it's, gets relegated down to LoopNet or some of these other online services.
Okay. And believe this is our last one. James asks, how is COVID impacting your business? Are tenants not paying rent, and how are you adapting?
So COVID is currently is not significantly impacting our business. We've got some properties that haven't been. We've got some properties that don't even realize that there's a pandemic going on right now. We've collected 100% rents on one of our properties for the past 3 months, which is not even heard of in regular times. And so, and in May, this past month, we actually set records on some of our properties. So we're cautious, but currently we haven't had a significant impact to collections at our properties.
Okay. All right. That looks like that's all the questions. Nhan, I'll go ahead and pass it over back to you.
All right, wonderful. Nicholas, thank you very much. Daniel, thank you very much for the wealth of knowledge you provide for us tonight. And we do appreciate your time, and we do appreciate yourself. And hopefully we'll see you again in person once we get back to the Gainesville Marriott. So the next part of the presentation, guys, is going through our raffle. And every month we'll go through a raffle to give away a free 30-minute mentoring session to those who qualify. And since we're Fortune Homes, we do have a Wheel of Fortune. So I'm going to turn it over to Ari, and Ari's going to go ahead and share her screen to see who won that raffle. So Ari, I'll turn it over to you. Ari, can you hear us? We can't hear you. You're muted. There you are.
Hi, everyone. So we're going to go ahead and start the Wheel of Fortune. Can you guys see my screen? I think our wheel is pretty colorful. Are you able to see it?
Well, where did it go? Oh, there it goes. Yeah, we see it now. Go ahead.
All right. So, good luck to the lucky winner. The Dynasty Estate.
The Dynasty Estate.
Yeah, I don't exactly know who this is, but I will go ahead and look at your information and I will try to reach out to you sometime tonight.
Okay.
Congratulations.
All right. Thank you, Ari. Well, Dynasty Estate, whoever you are, congratulations. Ari's going to be reaching out to you later this evening and coordinate with you scheduling a meeting to get you guys in there. And again, if you're already an experienced investor and, we can spend that 30 minutes talking about how we can do deals together, what we have done in the past, okay? Whether you have a specific goal in mind or whatnot, okay? So go on to the remaining part of our presentation here is make sure you if you are connected to Facebook, make sure you like us on Facebook. All right, it's facebook.com/Fortune Homes Team. And also next month on July the 1st, we're going to be having our very next meetup, and this is actually going to be virtual as well. And we really hope this will be the final virtual meetup, and then we'll get back to the hotel space sometime in August. But we have a special guest speaker for the topic how to find funding for your deals. Now, Daniel mentioned a couple of things about that already with capital raising with regards to multifamily, but we're going to talk about how to raise funding for different facets of real estate, including fix and flip, buy and hold single unit rentals, and other different types of investments that you can raise money for. Now, the market has changed in the last 3 months in the capital financing area. And certain things have changed, and they'll be going through a lot of the details on exactly what has changed and how you can leverage that for yourself in new deals in the future. So our guest speaker will be a representative from Washington Capital Partners. For the last several years, they've been the #1 hard money lender in the DMV area for the last several years in a row. So very great wealth of knowledge. There's a call to action on top there where it says register now. So make sure you register now and get your spot secured for July 1st. So with that, guys, thank you very much for joining us tonight. Hopefully we got a lot of information here. We'll go ahead and close out the meeting and look forward to seeing everyone next month.